Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. You know, I'm getting questions this week about Social Security and no cost of living increase. So we look at that and we say, for all Social Security recipients who are on Social Security, receiving Social Security income, every year, the COLA, cost of living increase, is calculated, and usually the Social Security check goes up by whatever the cost of living adjustment is. Well, the problem since probably 2008 is with the financial crisis and the engineered low interest rates, we've seen no increase for 3 years since around 2008. Prior to that, I don't think we ever saw a year with no increase or no COLA. So now we're in a situation where year after year, retirees are fearing, will our checks, our income checks, not go up? And that's exactly the case for 2016. The Social Security checks are not going up. So we've always looked at that as, oh, well, it's another flat year where we're not getting an increase. But this year it has special ramifications because it affects other areas in finances for retirees. The problem is this: we have no inflation on the cost of living calculation. We have no inflation on a lot of the areas, but for seniors, they're being especially hard hit on medical costs and increasing property taxes. So while we're seeing the areas that impact seniors and retirees so much, to say there's no cost of living increase is not actually correct in your segment if you're a retiree. But here's the problem this year. Medicare Part B Premiums. And you say, what's that have to do with Social Security increase? Well, usually nothing. The Part B Medicare, I want to share this with everyone. You have Part B Medicare costs. If you apply for Medicare and are receiving Social Security, they deduct the premium, which is usually around $109 a month already, from the Social Security check directly. Almost everyone has that case. Now, I will share this with you. There's an optional voluntary deduction. You can also have taxes withheld from your Social Security check. Most people don't know that. The reason I bring that up is we run into people filing quarterly tax returns, quarterly estimates. I see no reason for filing quarterly estimates for retirees. But the majority of retirees that I know are filing quarterly tax estimates. So people will ask me, what do you mean you don't see any reason to file it quarterly? Well, I'll tell you why. You're normally only filing quarterly estimated taxes if you're self-employed and there's no one else to withhold the taxes, or you're retired. The federal government requires you file quarterly returns, which are quarterly tax estimates, if you don't have enough being withheld from your paycheck. Well, once most people retire, they don't have a paycheck. Many don't have a pension. So what you might have is all your income coming from your 401k accounts, your IRA accounts, your other individual accounts, or your Social Security checks, none of which automatically withhold. Now, you can ask the 401k accounts, the IRA accounts, and yes, the Social Security check to withhold for taxes. And I know most people don't know that, or they wouldn't be filing quarterly. What quarterly means is this. You have to do manual paperwork April 15th, July 15th, September 15th, and the following January 15th, which is your fourth quarter, estimated tax payments paying in advance to the IRS, or you could be penalized for underreporting. Hey folks, make it easy on yourself. Withhold from all the sources of your checks, and you won't have to file your any quarterly estimates, which means you don't have to care anymore April 15th, June 15th, September 15th, that you have a job to do. The reason you retired is to get out of work. So don't create another job for yourself. Contact Social Security, make the election, withhold federal income tax at the appropriate rate for you, talk to an accountant, and get your withholding situated so that it's automatically happening from every check. Now, you don't have to handwrite those checks, manually send them in, remember your envelopes. You don't have to remember any of that. So I just saved you a job. Now, back to this no COLA in Social Security. Folks, anyone that has been reading the papers knows the Medicare Part B Premium is scheduled to go up as much as 50%. Starting the beginning of the year, you could see your withholding for Medicare. Well, it's not withholding. You could see your Medicare premiums go from what would have been $109 to $159 or $160 just due to this increase. So let me give you some details on who this affects. For those of you receiving Social Security now, for those of you who already have your Medicare premiums deducted from your Social Security, you would normally see this increase except for a little known loophole that says you will be exempt from any increase if there's no COLA increase on the Social Security check. So for any year there's no COLA increase, your Medicare premiums are frozen. That's almost 70% of everyone receiving Social Security who has their Medicare premiums withheld. If your Medicare premiums are not withheld, you're not exempted out by this provision. If you're not yet receiving Social Security and begin receiving Social Security in January or February, you're not exempt because it's only exempted for those who are already in 2015 receiving Social Security, number one, having their Medicare premiums deducted from that Social Security directly, number two, and having no cost of living increase benefit on that Social Security check for the following year, number three. So if you meet all three of those requirements, you're exempted from this year's increase on Social Security. And like I said, that's estimated to be about 70% of you in retirement on Social Security. So what about the other 30%? Well, guess what? You very likely may be faced with having to pay over $150 a month for your Medicare Part B premiums, really subsidizing all those who don't have an increase. They're hammering those of you who they can get. They meaning Medicare. So you're bearing the brunt of the burden, where if 100% of the people on Social Security were sharing that cost, it's estimated it might only go up $10 or $15 for everyone. Now that seems highly unfair to both you and me, but that's what's happening right now. What can you do about it? Number one, right now, if you were considering going on Social Security but waiting for a year or two, as many financial planners will suggest, deferring the decision to take Social Security is a complicated one. There are many provisions in that decision. What's the crossover point? What if I wait too long, take Social Security, I wait to take it at 66 or age 70, die prematurely, what happens to that money? Folks, that money's gone. It's not in the bank for you. It's not in your bank. So many people will say, well, if that's the case, I'm taking Social Security checks early. I'm starting mine as early as I can at 62. That financial decision can also be wrong. It can be wrong because many financial planners would share you're taking about a 25% hit or reduction on what would have been your otherwise full Social Security benefit at age 66. So if your full Social Security benefit was estimated to be $2,000 a month, and you could see that by the annual report that is sent out by Social Security, they send out a Social Security estimate somewhere around the time of your birthday. If you don't, you can go on ssa.gov, register on that site, and get estimates anytime you want on what your Social Security might be if you were disabled, what your Social Security might be if you retire early, what it might be if you wait until normal age. So let's say it's $2,000 at age 66 that you're expected to receive as your Social Security benefit. Guess what it is if you retire early or take that benefit early? At 62, it's estimated to be only around $1,500 a month. You are shorting yourself $500 a month for the rest of your life. Now, granted, the cost of living increases will push that up year by year by year. So between the age of 62 to the age of 66, it's estimated in our common advice that you might see 1.5% to 2% cost increase by COLA. So if you retire take that Social Security early at 62, and it's $1,500, and you get a 2% increase age 63, then you look at that and you say, well, that's $1,500, and then now it's $1,530 the next year. I got a 2% increase. And then the next year it might be $1,570, and then it's $1,600. So you might be up to $1,650 or so, let's say, by the time you're 66, as opposed to $2,000. So it really only maybe cost you $350 difference by the time you got to age 66. In addition, you received all those extra checks, full checks of $1,500 plus cost of living increases for those provisional 4 years or 4.5 years early. Well, that's $1,500, which is $18,000 a year, times 4 years. You're almost at $20,000. You look at that a year, $18,000 a year times 4 years. You figure you've gotten an extra maybe $80,000 out of the government before you hit age 66 versus waiting till 66 and getting zero. So you can see the problem in calculating this, because the other financial advisor's side of this point is, okay, but age 66, you're earning an extra $500 over whatever it is. $500 a month is $6,000 a year. Times 10 years is $60,000 plus the cost of living increase. So between 10 and 13 years, it's estimated that you will have recovered what you lost by not taking it early. So you say, yeah, but at 66, 13 years, I'm 80 or 79. And after that point, your checks are higher than they would have been most likely, it's determined, or at least we look at that as a possible scenario, than the benefit of having taken it early and having gotten an extra early $80,000 out of the government early. Now, here's something that's not usually factored into this. What if you take Social Security early, but don't need it and don't spend it? So you're just taking it to get it out. And you now have $80,000 in the bank by the time you're 66. And that $80,000 is earning 3% interest every year, and you've not drawn on it. Well, then that further extends that break-even point where waiting was not as advantageous, possibly, because now at age 79, or 80, where our break-even point would have been in 13 years or 14 years. But you've got an account at 80,000 that's now worth 100 maybe. In addition, you're now receiving full-size checks that clearly offset. You got all your money back out of Social Security. Also, that extra 80,000 in your $500 a month extra over 13 years. So you got it out twice. So if you're looking at taking Social Security early and banking it, it's a third option that needs considered. Well, now we get back to this COLA. And the cost of living increase that I just said factors into that equation didn't happen. So now your Medicare costs might go up 150% if you don't have Social Security already by November of this year, December at the latest, with Medicare deducted. Then you're not exempt from next year's increase. So if you were planning on taking Social Security in January or February, and you're delaying that decision until January or February and then going to take it, your Medicare premium will likely be $159 or so, where it might have only been $109 had you started your Social Security in December. How about that? So I know a lot of people aren't evaluating these scenarios. Here's another one. The new budget plan. The new federal budget plan that just went into effect is closing a loophole that's being exploited by many financial advisors and being promoted, which was this file and suspend. But you know what? They're actually taking advantage of a provision in the Social Security law where someone could come in at normal retirement age, file, and then suspend immediately. So they're filing for Social Security and then saying, oops, never mind, put it on hold. So that's a file and suspend strategy. Why did they do that? Well, to game the system was a provision saying if you file and suspend, your spouse can still take, and they can be receiving spousal benefits in advance, and you're still filing and suspending. Why would you do that? Because remember I said every year you wait. You know how I said there's a 25% reduction between 62 and 66 in essence? Here's why. Every year you wait to take your Social Security, it's about another 8% added to your account. 8% additional income for every year that you wait. So what was happening is you'd file, you might be eligible at $2,000 a month, you stop by suspending, and next year you're eligible for not $2,000 a month, but 8% more than that, which is $160 more a month. But in the interim, your spouse, because you filed, can now file as a spousal benefit. So your spouse might be receiving the common 50% of whatever the primary holder or recipient would have received. So your spouse might be receiving $1,000 a month early. You're not receiving the $2,000, but you filed and then suspended. And then your check keeps going up 8%. You're not taking it, but your expected check keeps going up 8% every year. You wait till you're 70, let's say. Your check might be $2,500 a month by then. And then you start taking it, but they were receiving, the spouse, the $1,000 plus the cost of living increases. You see how complicated this can be? Well, that's gone. The new budget plan killed that. It did not kill file and suspend. It did kill this file and suspend and exploit for the survivor benefit. So that one's gone. So we now look and we say, well, okay, that's a game changer. Doing it was a game changer, but so is not having it. So here's what I want you to see. I want you to see common sense. I want you to factor into this common sense, and I want you to think about your retirement income needs. Is it possible you could get by right now on just the income earned by your 401k plans or your IRAs? Now that brings up another point. Many people will say, how much can I safely withdraw from my 401ks or my IRAs or my accounts? And I guess the answer might be there is no fail-safe amount that you could safely withdraw because we don't know what's happening in the future. If you have a $100,000 account and we say 2% interest is being earned on that account, and that's a safe amount to take from the account, but the 2% is actually dividends on dividend-paying stocks, and the stocks could go down in value, or 2% yield on bonds, and the bonds could go down in value. Maybe it's not safe to take anything out of there. Maybe the 2% needs reinvested to prop up or shore up the account value to help account for market drops, right? To help buffer market drops. So we have to be very careful on what is safe to pull out. Some advisors will say, well, it's safe to pull out at least the interest all the time. And again, another advisor will say, well, I'm not sure that's safe because that means my whole principal account is level. It's not growing if I'm taking out all of the earnings, which is interest. Let's say it's in bonds or dividend-paying stocks that don't go up in value, or even bank CDs. I'm taking out all the interest. The $100,000 might still only be $100,000 10 years from now. And that means my income is still level if interest rates are still only at 2%, which means I don't have an inflation factor in there that my costs keep going up. Don't I need a growing asset base? That gets into a much more complex issue that we're going to talk about than we can talk about today. But very valid one. Should we have enough assets or ample assets that we're only taking half of the interest out, leaving half of the interest in? The other side of the question is, if you have a lump sum of money and people say, yes, what's a safe withdrawal rate? Some people will say 4%, no more than 4% or 3% rule of thumb. Boy, is that dangerous. If those funds aren't earning that rate, that means you're asking how much can I withdraw from principal before I run totally out of money? Could I end up outliving the whole assets? That's an extremely risky question that you're asking and hard to calculate. So finally, I bring up with you delaying Social Security. If you are married, remember this. The longer you delay your Social Security, if you can afford to live without it, you're also building your spouse's survivor benefit, because your spouse will receive upon your death the higher of the 2 Social Security checks that come into your household, which means at least your full check will continue to your spouse. So for the sake of spousal protection, you may want to build your check as high as it can possibly get if you don't need the money right now, because they'll get the higher of the 2. And remember, they'll be losing a check at the time of the death of one of you. So you may need as much in that second bigger check as you could possibly get. All right, folks, that's it for some of these discussions on Social Security I wanted to bring up that I've been being asked. I'll be back again next week, and thanks for tuning in.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.